Hey there guys, welcome to this month's Fundamentally Speaking, where we are going to talk all things fundamental. So young Mitch, what have you got for us?
Thanks for having me on the show, Mr. Baxter. Absolute pleasure to be here. Fundamentally Speaking, where we go through the fundamentals of the market and the economy, what's going on, obviously in the month that we're chatting about today. And specifically, where I'd like to start, it's very topical at the moment, and that is the almighty tech sell-off. We've just seen the tech sector peel back by sort of 10% in the last week, the NASDAQ specifically. Why is that?
From a fundamental perspective, I don't think there's anything that's changed. I think it's a pure sentiment sweep. Companies that have had a really, really strong run, bit of profit taking there. I think also SoftBank, the Japanese bank, been reported to have a pretty large exposure to the tech sector using a lot of options and derivatives in that.
Can you tell us more about that, interestingly?
Well, the backstory, if it's to be believed, is that they had some really, really massive positions running on Tesla as well as the NASDAQ. Tesla failed to get included in the S&P 500 last week, so the share price came off quite heavily on the back of that.
20%?
Yeah, so a bit of selling on the back of that, and it's shaken the tin, so to speak, and everyone else is running for the hills. Has anything changed in that sector? Not really. Is it overvalued? Yes, but not across the board universally. There are stocks there that, even though they're on a multiple of 120 times like Amazon, it's still reasonable value.
So are traders now deciding from a fundamental point of view that this is the level where they can take profit and then start to rotate into more, say, defensive or economically sensitive stocks on the Dow, for example?
I don't think there's a level of nervousness. We've seen volatility sort of drifted down, and then we saw volatility start to rise up, albeit in a rising market, which is actually quite unusual. And I think there's maybe a little bit of nervousness there where people think, okay, let's take some dough off the table. And let's face it, the tech sector has had such an incredibly strong run, obviously in the US, but even if we look domestically at some of the minnows we've got, like Afterpay and the like, they've had an incredibly strong run, and you think, well, when's enough? And good time to book some profit for sure, and I think that's what we've seen.
I think, that those tech companies have been at the forefront of the market news, and I've been reading a lot, as you and I are both news addicts, is that it almost feels like there's kind of two economies from a fundamental point of view.
Yep.
There's the tech sector, and then there's basically everything else. And obviously up until last week, the tech sector was outperforming by a hell of a lot.
That's very much the case, and we're looking at businesses that are sort of future-proof. You think about your Amazons, your Facebooks, your Teslas being the obvious ones, PayPal, and now that's obviously moving into the payment services space, which is why Afterpay has probably come off half as much as it has. But tech is going to be a bigger part of the future than it is now. You look at stocks like Zoom, phenomenal numbers. 400% jump in revenue, 40% jump in its stock price.
Crazy.
And it's a stock of the future. Is it overvalued? Probably not. It's become the new norm of consuming information, looking at the green dot.
And if we talk about valuation on these companies, definitely get our members to listen to our tech podcast that we just recently released, because that talks about valuation in a very, very tough way.
That's right, boom, bubble, bust. I mean, it just shows that you can't use normal valuation tools on the tech sector. It's a different type of business. It's just what it is, and it needs its own set of lenses to look at it. But what's been going on there certainly is, I think, unsettled a few people, because this rally that we've seen in markets post the correction, from really March 24th, a lot of new money's come into markets, and it's only known one thing since it's come in, and that's bottom left, top right. So as soon as there's a little bit of turmoil, that nervousness, that sort of amber lights come on, and quick, let's get out of this before it cuts up too rough. And,
sure.
and it's not surprising to see that. It's had an amazing run.
Absolutely.
But that's one small sector that we're really looking at. There's plenty of other stuff that are far bigger picture items that we can talk about, I'm sure we will, that are probably more significant, but they haven't really got the airtime that tech sell-off has got.
Okay, well, to segue into that then, in that case, let's talk about probably, let's say China, because obviously there's a little bit of nervousness around the relationship there with the US and of course us. Iron ore prices, for example, are a big part of our exports, especially with Fortescue Metals. Share price gone through the roof the last couple of months. What's your depiction on that whole debacle?
Look, China, I think there's been some issues with Australia. I think China's got issues with just about everybody at the moment. If we look in the, China and India right now arguing over a particular border position in the Himalayas, and you've got the, two of the world's most populous countries. Both of which are nuclear countries too. India has nuclear weapons too. So it's the sort of thing you've got to watch. In the back of the mind fairly carefully as to what's going on there. But China has been playing a really interesting trade game, and unfortunately Australia, we've got to learn. Shut up. Just shut up.
One of our many downfalls is Aussies, right?
Yeah, we're 1 point.
You're lucky from the UK.
1 point nothing percent of the world economy. And I say that someone's very proudly Australian, so this isn't an Australia bagging session, but yeah, we're 1 point nothing of the world's economic system, and yet we kind of beat our chest as if we're, the puppet for the US, which I guess to an extent we can be. We've got strategic relationships with the UK, and we've got strategic relationships with the US that are historical and they're important. But our number one trading partner is China. And the more you annoy your biggest trading partner, the more they're going to annoy you. And it just goes into this snowball effect. And this is by no means one-sided. So, Australia has come up and it's gone to the World Trade Organization complaining about Chinese dumping of steel, amongst other things.
Sure.
So we've been, poking the bear, and they've done the same thing back. And look, does their case have a lot of merit? Not really. It's what it is. It's a pulling of the leash to say, pull your head in. Barley, for example, I think the Chinese have cited that there's unfair irrigation subsidies being provided to Australian producers. Barley's from Western Australia. There's no irrigation in Western Australia, so it's an ambit point before you start. Nonetheless, we've seen those 30% tariffs go on grain. We've seen that then move through into other areas. The dairy industry has been talked of, the meat industry. We've certainly seen that where Australian beef has been rejected for quality standard reasons, which beggars belief given we grow some of the best beef in the world here. And we've also seen the wine industry cop it, and Treasury Wines is a really good proxy for that, which has been absolutely decimated, from $18 down to about $9 on the back of, and China's its biggest market, of course, for brands like Penfolds and the like. So, it's been pretty serious. Looking forward, you think, well, we're okay. Our iron ore producers, Fortescue, BHP, continue to do well. Iron ore is $110, $120 a ton, but that's now. And China has invested massively. It's got billions and billions of dollars invested in a country that 99% of the people listening to this broadcast won't even know where it is, and that's a country called Guinea, which is in West Africa. And China has invested massively in iron ore resources there. It's not come online yet, it will, and when it does, that's where China will get its iron ore from. So we're deluding ourselves if we feel we've got this special relationship in the iron ore space. It just happens that there's no alternative. Brazil's got its problems with Corona. It's also a long way away from shipping, although China's have been building new mega transport ships to bring iron ore from Brazil. So Australia's position there is very, very vulnerable. And we need to be a little bit smart. None of the rhetoric in Parliament of, we're going to get these Chinese sorted out. They're our number one trading partner. Talk it through, work it out.
Sound like a true fundamentalist, Mr. B. To dial that up, and I'm going to put you under the pump here, do you think, in all honesty, that China's a security threat?
Yes and no. I think China's got its own interest at heart, as virtually every other sovereign country in the world does. And look, the UK and the US have taken a fairly strong stance on things like Hawaii and 5G and things like that. From a security threat perspective, we've seen evidence of it. Its involvement, I suppose, in politics in Australia and various interest groups and things like that. Yeah, there's a lot of investment in Australia, so they're kind of looking after their own interest. Is it a security threat? Well, we've got an army of about 4 people in a Land Rover, not besmirching our own swords, up against 100 million troops. There's no contest there, and hence why our strategic alliances are with the US in regards to defence. But China's conduct in the South China Sea is a land grab. From talking about this, we can go into a lot more detail about it, but the relevant point here is very, very simple. Until something kicks off geopolitically, properly kicks off, shots are fired in the South China Sea, a boat sunk, that's a game changer. Talk of trade tariffs between the US and China, that is a game changer. But while those two things sit on the back burner, it's an issue and it's something to be minded of, but it's not front and center. There's got other issues that are probably more pressing and more impactful on markets than that, but don't lose sight of the fact that China and the trade tensions that we have there is a very, very important point. And this sort of comes into prioritization. It's nice to know what's going on fundamentally, but it's then a question of being able to rank it in terms of, okay, is this affecting our market today? Probably not. Will it affect our market? Massively. Has it affected certain stocks? Certainly has.
Sure.
But is it the main driver in where we're seeing the Aussie market right now? No, it's not. But it could easily be if any of those geopolitical factors really flare up.
Indeed, that's a really, really good point, and very important to note, of course, if you are looking at trading any of these fundamental point of views. Let's talk about something that is probably at the forefront of our minds, and that is, in fact, the economy. I know you're an economist, you could talk all day about this. We are on a time limit here from our AV guys. The economy, what's going on?
Can we get a couple more minutes, guys? Because we can go all day. On this. What's going on? Look, we are in a very, very precarious position economically, and hard to really comment on this without sort of getting on on a soapbox, I suppose, and there's no political agenda with these comments. It's just common sense, I suppose, and common sense and politics don't always go together. Yeah, we've got a scenario at the moment where we've got a federal government that is not in control of our country, and it's certainly not in control of our economy. That's being dictated to by various states and territories around the country in terms of their policy, be it on borders and the conduct within those borders. And Victoria, is an easy example to pick. The Chairman Daniel Andrews, the Premier of Victoria, the measures that have been put in place so draconian and beyond what are probably needed, and the impact, you've had 7% increase in unemployment, just not unemployment going to 7%, but a jump in unemployment by 7% in Victoria alone. You've got a situation where a lot of companies, given the choice, will not invest in Victoria going forward because of the partisan way and things are being done there, at a time where as an economy we need as much investment going in at ground level. Now, of course, you look at payroll tax and things like that, and I know the Victorian government have just rolled out today some changes and suspensions. Victoria's got the lowest threshold for payroll tax. I think it's 750 grand, it's $2 million in Queensland.
Sure.
And this is this additional tax you have to pay to the state because you employ over a certain amount of people on your payroll.
Sure.
So, it's not job friendly, and you're going to see that really run through in the aftermath of this, which will affect the economy at a grassroots level. You're going to see property really struggle. Why? If you can't get finance, you've got no job security, you've got no overseas investors coming in, who's buying all the apartment blocks that you see going up in the air?
No one.
And
sure, it's not us, but no one's got a job.
Well, we're fortunate we're employed.
You and I are, absolutely, we are.
But we're in a situation where we're very fortunate in that regard. But a lot of people out there looking over their shoulder that these sorts of things are going on. So from the Aussie economy point of view, the biggest risks. Yes, we've got unemployment, and it's going to become structural unemployment unless there are some really, really strong measures that are implemented. And I've just been putting together a report on this, and I think we're going to do some member-only training.
I'm excited for it.
We've got universities are empty, no foreign students. So for Christ's sake, get some people in there studying. So if people need to be retooled to be able to compete in the digital world, in the job market,
get them in there and teach
them. Get them in there now. Stop paying job seeker. You're not going to get a job because there are no jobs being advertised. Get in, reskill, upskill, and have a talent pool or skill set that's going to set you up for the job market when this blows over. That's a pretty fundamental, obvious thing. But looking further into our economy, I think there are a number of measures over the next few weeks that I'm looking at particularly. Obviously, we've got the wind down to a lower level of JobKeeper. Personally, I'd get rid of that too and just pull the Band-Aid off. You're better off just seeing it as it is rather than delaying what's coming down the hill. But more than that, the honeymoon period for the banks is coming to an end. Next week is the first tranche of people that have been on this 6-month payment holiday from the banks. And if you look anecdotally, Westpac, for example, are increasing the number of staff in their mortgage arrears and repossessions team. The writing is on the wall. I saw this firsthand in the UK, 89, 90. I was still at uni then. My cousin lost his house, it was repossessed. A number of people in that situation in the UK fell foul of negative equity situations and big problems there. And I see that coming over the horizon for us here in Australia. So if you've had a payment holiday for the last 6 months, you're going to have to resume payments very shortly. Chances are you may or may not have lost your job. Secondly, those payments are going to be higher because you've had a 6-month holiday and that principal is now moved on to the loan, as is the interest that's been accrued. So your payments are likely to increase as well. If you've lost your job, your payments have increased, and touch wood at this point in time, we can touch on this beautiful timber here, touch wood at this point in time, the Australian property market's been reasonably robust because there's not been an oversupply coming to the market. And you can see that locally. Look at here on the Gold Coast, for example, there is no quality stock in the market. There's hardly anything available.
Sure.
And part of that's a lot of people from Victoria have moved up here. Don't blame them. You've got free movement to go around and do stuff. You're not under curfew. You're not going to get arrested for having a dash cam in your car, and so on and so forth. But, without diving deep on all of that, as soon as you start to see an increase in supply of property coming into the market, you're going to see some fairly substantial weakness, I think, across major cities. And a lot of properties that are held, of course, aren't primary places of residence where you're going to fight tooth and nail to keep the roof over your head. They're investment properties, and if there's no tenant in there anyway, we'll wind that up. It's in an asset structure which we can, if there's no personal guarantee, for example, just wind it up and walk away from. And you're going to start to see that swell come up. So there's a couple of things I'm looking for. Increase in stock in the property market, looking at mortgage delinquencies and arrears, and more importantly, looking to see how the banks are going to treat that. If they do it very carefully and manage it, that's okay. But if it's a really hard-nosed approach, you are going to start to see some significant weakness in the property market, which serves nobody, because bad debt that the banks got. People want to say, oh, why would the banks want to sell you out? Let's say you paid $500,000 for your property. You haven't paid a mortgage for the last 6 months, you've lost your job, and you've got a 450 grand mortgage on it, 90% LVR. Property value drops, and let's say it drops pretty significantly to 400,000. There's 50 grand of negative equity there, which is your debt, by the way, not the bank's.
Sure.
They don't want to sit with a balance sheet that's now got a 100 grand hole in it because their valuation was at 500, it's now worth 400. They don't want that on their balance sheet. That's damaging because it affects capital adequacy and a variety of other things. So they want to spin it out. They'll take a 100 grand hit on it, or some sort of hit on it that you're going to end up paying and patching up anyway to get the tax reduction now and get the bad debt off their balance sheet for the long term. Very, very important. Problem is, when you get a lot of those, it starts to push prices down even further.
Sure.
So they want to get in early and get this squared away. So watch that very, very carefully over the next couple of weeks, and more importantly, the next few months. Now we're looking through the microscope of what's going on here, but banks already, which are such a stalwart of people's share portfolios, we've already seen all the warning signs. And if you haven't picked up on the warning signs yet, let me slow down and use smaller words. It's going to get worse for the banks. Okay, you can't make it any clearer than that.
It's a big statement.
Earnings are going to continue to get pressured. Rates are low. You're going to get an increase in mortgage delinquencies. You're going to have an increase in arrears. You're going to have people defaulting on loans, all as a consequence of where our economy is. Dividends have already been cut, which was the right move. And so for any long-term shareholder that's already holding banks going, oh, well, the dividend's cut, it'll come good, don't expect that in the next couple of years. Simple as that.
Wow.
And that's really doom and gloom, and I hate to be that person.
Sure.
But our duty of care is to make sure that our followers, our clients, are in a position whereby they can ride this out and avoid tripping on this landmine. See, banks are good value. Commonwealth's only on a 15 times earnings. It's cheap. It's a good time to buy. It is not a good time to buy. It might be a good time to trade, but it is not a long-term buy at these levels. Sure. Not with the storm that's coming over the horizon.
Yeah, very bold prediction, my friend, but I dare say it will be correct, because I know as the true fundamentalist economist that you are, you're often right. And this is exactly what this broadcast is about. It's about having this hard discussion, whether it be positive or negative, to help our customers steward themselves in the best way. So, look, Mr. B, we are coming towards the end of the broadcast as such, or the discussion.
But we're already just starting, we're just getting the hands.
I know, I'm sorry.
Can we sort of make this a 1 hour?
We've already gone over our 20-minute time cap. Sorry. Apologies, we have to apologize to the team out there.
I don't normally last this long.
Neither.
I suppose that's why I've got 4 kids. Anyway, let's not get into the ins and outs and nuts and bolts of that for a moment. Yeah, the reality is, you've got to have your eyes open right now. Just because I'm talking about a gloomier economic outlook, that's more than likely what's there. What that simply means, it doesn't mean pack up your bat and ball. It means you've got to just nudge the strategy, be more selective in the stocks you're trading, shorter time frames, stronger quality risk management, buying puts, as we did a couple of weeks ago, are all parts of that. Not blindly going, values are cheap, let's get in. Because this market's been so range bound. We talked about this in Technically Speaking the other day, 5,900 to 6,200, running spreads on that either side of it as we speak. Because it's metronomic. It seems to happen with it comes around. It's a beautiful quote for you. It seems to come around with the tedious regularity of an unloved season, and that is 5,900 to 6,200 in this market. It's a trader's market right now, and yes, there is some value in certain stocks that you might want to pick up, but by and large, keep those traders' lenses on it, because the fundamentals from a long-term buy perspective. We've talked about the banks and the economy here, and whatever is going to happen as we have to run into Christmas, it's not going to be good for retail. I haven't even talked about retail. Retail's done. Think about Meyer David Jones, as we were talking earlier. Game over. It's done. It's done. There's no recovery from this.
Myers is 26 cents.
26 cents, so you only got 26 cents of upside if you short sell. There's not enough value in that anymore, is there? Better shorting it from $4.50 when it listed. The reality though is that whole sector is under tremendous pressure. The Christmas rally in sales is not coming over the horizon because people are trapped at home at the moment in certain states. It's going to be online. Those businesses are dinosaur business, and they've failed to evolve with time, so they don't have a decent online presence. Maya click and pay. Click. Yeah, I like it, pay, come to the store to pick it up. That's not how things work in 2020. It just simply isn't. So they're done. And that's going to cause further pains. More learners, we're already seeing, Chadstone's been written down by a couple of $1 billion in terms of what it's worth. people that are employed in those stores, where do they go? More people on the scrap heap, unfortunately, for the moment. So yeah, that's one area in retail. We've talked about the banks and the softness of the property. We've got on the horizon over there China and some of the geopolitical tensions, not to mention a self-implosion in terms of the lack of federal steering on how we've been able to get ourselves out of this corona state by instead allowing different partisan states to dictate what's going on in their country. That is a really unsettled environment fundamentally. It doesn't mean it's a bad environment for trading. In fact, that uncertainty creates opportunity, which is what we love. Just got to look through those different lenses, mate.
There you go. That's the best advice I've had all day. Thank you, Mr. B. Look, absolute pleasure. I think there's a lot to unpack in there, and obviously some very, very good points that are at the forefront of our minds, and obviously, no doubt, will affect our market going forward.
Let's see how they go. Hopefully, we're way offline with this, and it's going to be all tea and cake as we run into December. But at least you've heard it here first. Traders market, not a fundamentalist investors market. That's for sure.
Fundamentally speaking, thank you, Mr. B. Been a pleasure.
As always, thanks, Mitch.